Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 20th of June. I'm Daniel Lam, your host for the podcast. As you may be aware, there are 11 equity sectors under the MSCI classification. The Standard Chartered Wealth Management CIO team makes house view on the sectors in MSCI US, Europe, and also in China. Now, recently I took a glance at the house view and realizes that the only sector that we're underweight across all the three regions is real estate. Now, naturally, high interest rate is the universal driver against the real estate sector because it means more expensive financing costs in mortgages, thus dampening the liquidity and sentiment in real estate transactions. But in China in particular, real estate developers have been facing challenges in liquidity and financing of projects over the last few years, leading to very volatile bonds and equities prices. Our colleagues in Global Research publishes their proprietary China Developers Sentiment Index, abbreviated to CDSI, which is a survey of 40 mainland China developers. Now, a 50 reading is a neutral mark, and there are three observations here. Number one, the index fell further to 38.2 for the second half of 2023 versus 40.6 in the first half. Secondly, 40% of the developers expect slower home construction over the next 6 months, which is up from 25% in the last survey in November 2022. And thirdly, by city, the survey shows that developer sentiment in Tier 1 cities fell the most, to 42.5 for the second half of the year versus 52.5 in the first half of the year. Now, it is true that policy easing has lowered the developers' borrowing costs further. The average interest rate developers pay for bank loans, non-bank loans, and bond financing declined by roughly 60 to 70 bips over the last 6 months. However, there are still challenges ahead. For example, 70% of the developers expect some defaults in the industry on bank loans over the next 6 months, versus 58% in November. And longer term, 73% of the survey developers expect new home sales to decline by 0 to 10% per annum over the next 5 years, due to a combination of declining population, slower economic growth, and a maturing housing market. So from an equities perspective, we believe in sectors in China that are benefiting from smaller items consumption, such as consumer discretionary and communication services. Those are the two sectors in China that we're overweight upon. Now, on the Asian US dollar bond front, our preference lies in Asian IG US dollar bonds, which take up close to 90% of the Asian US dollar bond composition. Now, many of the China property bonds are in the Asian high-yield dollar bond space, and as we heard above, the fundamentals remain tough. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.